Thank you everyone for coming out on a slightly wet morning to hear Julia and myself talk about practical approaches to insolvency risk in construction projects. We've split it into two parts. The first part I'm going to be focusing quite a bit on retentions, but we'll also wrap that up with some practical stuff at the end. And Julia's going to be talking about things that can be done to try and mitigate risk from a contracting perspective.
Okay, thank you, Jonathan. So welcome everybody this morning. So as Jonathan says, we're going to talk about practical approaches to insolvency risk in construction projects, which I'm sure you'll all agree and all be aware of is a particularly pertinent topic at the moment. So as you'll see, according to MB, as of the 23rd of May this year, there were already 92 companies in the building industry that had entered into liquidation, Armstrong, Oceanside and Condev amongst a few. I'm sure unfortunately there'll be many more to come before the year is out. There are a number of factors at the moment in the market that are leading to this trend. Supply shortages, materials and labour, partly COVID related, but mostly due to far wider global problems than that. Shipping industry issues, lack of ships, port authorities, factory shutdown in China, I could go on. Inflation, high volume of construction in the market, ongoing impacts of COVID in terms of isolation of workforce, and now the borders have opened, labour going out to Australia, etc., and difficulties in obtaining finance, particularly for development and construction type projects. Generally in construction, regardless of those market trends at the moment, there are various reasons why collecting money in the construction industry can be particularly more challenging than other industries. The projects tend to be high value and last for months, years. They're not week in and out jobs. They tend to be complex and there's elements of uncertainty, risk. And once Jonathan's talked to you about retentions, I'll be talking to you about some ways that risk can be managed across the project and things that can be looked at too. You can never get rid of that risk or the uncertainty, but to help. Clients are often highly leveraged and reliant on being paid by their own customer. Slim margins that can be eroded very quickly if something goes wrong or someone doesn't pay. Delays in payments from the top down, so although there is no longer pay when paid under the Construction Contracts Act, the cash flow is still a problem and it's still a challenge. Projects can be adversely affected by matters not within the control of any party, so your typical force majeure type events, adverse weather, delays in consenting authorities, that kind of thing. And final payments can be tied up in retentions, which can be withheld for many reasons, spuriously or not. So I will pass over to Jonathan, who will talk to you about the retention bill.
Thank you. So I wanted to focus a little bit on retentions because there have been a couple of cases recently that have highlighted some problems with it. We also had a High Court decision after the last attempt to fix what is a fairly cumbersome retentions regime, and that High Court decision in EBIRT has had disastrous results in the marketplace. So the government prepared the Construction Contracts Retention Money Amendment Bill to try and sort things out and get it back to what they'd intended it to be when the Act was first put into place in 2002. This bill, by the way, is still going through the system. It's having its second reading, so it is progressing. It isn't complete. It does envisage regulations, as did the original Construction Contracts Act, and we didn't get those. So hopefully this time round we will get regulations at the same time as we get this modification to the primary Act. And it's to strengthen and clarify the retention money scheme to try and ensure that retentions are protected in a way that means that the parties entitled to them can actually have confidence in being able to identify them and recover them in the event of an insolvency. That's practically the main purpose for which it's being put. Also, when the contract's live and the parties are in a relationship, it helps with that. But there are specific provisions in the changes, as we'll see, which deal with liquidators and receivers and what they are obliged to do with retention money. So currently, the Act requires any party to a construction contract who is withholding retention money, and this is any party. I'm still seeing people suggesting that retentions are only held at the upper level, and even if you have retentions in your contract as between a contractor and a subcontractor that you are not subject to this regime. That isn't right. Everybody has to comply with this at every tier of a construction contract. That's different to a lot of overseas jurisdictions which have the trust requirement but have a threshold. And we don't have a threshold. So even if you're holding $5,000, you've still got to comply with the requirements of the Act. If you don't have retentions in your contract, you don't have to, but then you'll have to find some other way of pricing in risk, whether it's bonds or something else. But if you have retentions in your contract, you have to do this, and there is no ability to opt out. You can call things something else, but if they look or smell like retentions, they'll be treated as being subject to the Act. So currently, you're obliged to hold the retention money on trust for the benefit of Party B, so that's the party that's entitled to it if they meet all of their contractual requirements, and the retention money may be held in cash and then, quote, other liquid assets that are readily converted into cash. That's never been defined, and has led to some interesting assumptions, including that it includes retentions that you yourself are owed, and other accounts receivable, which is, I don't think, ever been a sustainable argument, but some people have run it. You can have a financial instrument such as insurance or a payment bond as an alternative to retentions. Funds can be mixed, so you can mix the retentions trust treated accounts with your normal operational accounts. And a trust is not created automatically, and I say that because of the impact of the eBert decision. If you look at when Parliament first introduced the Act in 2002, they said it's going to automatically create a trust for retentions, and then the High Court said, no, we haven't done that. So the High Court decision in eBert required a trust to be specifically created, and the problem with that was when eBert fell over, there was a retentions account, but the record keeping was not perfect. At least they had one. And it didn't have enough money in it for all the people who were entitled to retentions. And if the paperwork and the record keeping was not in your favour in terms of identifying you as a beneficiary, even though you were entitled to retentions, you lost out. So the eBert decision was pretty harsh. So if your contract entitled you to retentions, you performed under the contract, but you weren't identified as being somebody subject to that account, you didn't get any money. And that led to a lot of ructions and submissions, and we've got this new bill as a result. Your only real effective mechanism under the Act as it stands to make sure that your retention money is being properly looked after is the ability to request financial information regarding the funds. You can do that at the moment. That power is there. Some people do it as a matter of course. Other people consider it awkward. I've been criticised for suggesting that you might like to use the power to request information about how your retentions are held, because apparently it's vulgar to talk about money once you've entered into a contract with someone, which I think is a curious position to adopt, but nevertheless it was suggested to me that it can be a bit awkward, so you don't ask and therefore you never find out. Yeah, you can't help some people. So what's changing? Well, now the funds are deemed to be held on trust. They've tried to come up with drafting that makes it clear to the High Court or whoever else that the funds are deemed to be held on trust, and that trust is created automatically. There is no need for an explicit intention of Party A to hold the money on trust. It reverses the eBert approach, and the trust is created when the amount becomes retention money, whether or not it is set aside or calculated. Now that's interesting, because if you take a freeze frame when a company goes into receivership or liquidation and there isn't enough money in the retentions account, the liquidator or receiver will still have to go through the exercise of looking at claims and determining whether or not a trust has been created for the retention amount under that contract. You're not automatically entitled to it, but I'm assuming that the contract's being performed, it isn't being withheld for any contractual reason like making good defective works. It's automatically created, and it doesn't matter what the company did or the labels that they put on it in their accounts. So it may be held either in a bank account or be the subject of a suitable financial instrument such as insurance or a payment bond. There are a couple of payment bonds floating about. There was one insurance product, but that insurer went into liquidation. So as far as I'm aware, there isn't one at the moment. Now, being held at a bank account, that is a bank account that you've identified to the bank and to everyone at large as being a trust account. Banks aren't going to like this. They don't like it at the moment because it's not the funds of their client. So when banks have security over the things in your accounts, in the event of defaults and payments to them, that won't apply to the funds that are held on trust because they're not actually owned by the bank's client. It's being held for someone else. So it is a requirement of the Act, but just bear in mind that it will be it is sometimes quite an awkward thing to explain that yes, it's money under my name. It's not an unusual concept. We have trusts all the time, but there seems to be a sort of psychological thing about accessing retentions to pay other bills that aren't retention related. So they can be used to remedy defects only following 10 working days notice and writing of an opportunity to fix defects, whether or not you've got that in your contract. And it's no longer permissible to use other liquid assets such as accounts receivable. So they've expressly ruled that out. They've sort of wised up to the fact that people were having one magic suitcase of 20 grand that they were going around showing what was probably up to about $200,000 worth of retention holders, saying we've got everything and the rest of it's I've got a chicken farm in Vietnam I'm selling and there's money on the way. Financial instruments, new requirements for third party or bank accounts such as, so as I was saying, the account must be established and used solely for the purpose of retention money, so it's not a working capital account, and they must ensure that the bank is aware that the account is a trust account. And any interest that accrues in the account belongs to party A, so not the beneficiaries of the retentions, but to the party going to the trouble of holding it. So the tiny amount of interest, although if inflation continues that might increase of course, belongs to party A. Can choose whether to have individual accounts for each subcontractor's retention money or to have one account which holds all subcontractors' funds. If the funds are mingled, then Party A must ensure that it has records in the form of separate ledgers identifying each party for whom money is held and the contract to which it relates, because of course your retention money that you hold will go up and down. So if you're doing that sort of amalgamated sum in an account, it's in your own interest, if you happen to be a Party A, to be able to separate out the reporting so that you don't have to show somebody everything when they ask for information about their retentions being held. And in fact, as we'll get on to, you're under an obligation to report that information. So it's important to split it out and make it as easy for you as possible. Those are two people with clipboards looking for their jib. So there's an obligation to regularly report. So you have to give specified information to Party B at the time the money is held, and every 3 months thereafter. That's the current requirement. Whether that survives into the final Act, I don't know. But there is an obligation to do it when the trust is formed and every 3 months. The information must include the most recent amount withheld, the relevant construction contract and the date of the retention. So on the face of it, not much information, but you'll need to have systems in place that enables this to be done in a way that is easy and accurate. And we're still getting, every week, people who don't even use the payment claim system in the Construction Contracts Act, and also don't keep, as far as I can tell, records of who they're contracting with, other than by individual staff members keeping that information on a piece of paper in their trucks. So people will need to be a lot better organised in terms of meeting the requirements of this Act. If held in a bank account, the name of the bank and branch, the name of the account, the name of Party B's ledger and the total balance. And if using a financial instrument, the name of the issuer, sufficient information to identify the instrument, such as a policy number if it's an insurance policy, and the protected amount. So those are mandatory minimum standards of the information, and the reporting regularly is there. It's an obligation. You can't contract out of it. If you have a retention, this will apply. Now, the effect of receivership or liquidation, when the retentions regime was first set up, the Act did not deal with what happens if a company goes into receivership or liquidation, which is a problem because both for receivers and liquidators, retentions are not company assets. They belong to somebody else. They're a company liability, but they're not assets that they can control. So if Party A is placed into receivership or liquidation, the receiver or liquidator under this new Act will hold the retention money on trust and must deal with it in the same way as Party A was required to do so. They can deduct reasonable fees and costs to do that. And the Act will also confirm that receivers and liquidators will not be liable for any unlawful or improper action taken prior to their appointment. So if there isn't enough money, they are not liable. They'll just have to deal with the consequences. But they don't have to go off to court because their current position is that receivers and liquidators are required to make an application to the court for directions. They can't automatically deal with retentions. And it's a huge pain for them. Some of them do, but they're not actually allowed to. So if liquidators come in and try and deal with retentions, they're not allowed to. And if they, for example, take fees or other money out of a retention account, they are in breach. So why do you do this? Well, because we all love being law-abiding citizens, and also because for the first time there are specific penalty provisions for entities who don't comply with the retention money scheme. So failing to keep, a fine of up to $200,000, this is on the company. Failure to keep proper accounting and other records of retention money is a fine of up to $50,000. Failure to provide regular reports, a fine of up to $50,000. This is on each contract, by the way, it's not aggregate. And if Party A is a company, each director can also be personally liable for a failure to keep retention money as required, with a fine of up to $50,000 for each director. And the fines are calculated per offence. So if a contractor fails to keep records for 20 subcontractors, the fine can potentially be quite significant. And I suspect, as with all these things, if that regime continues into the final Act, there will be a certain amount of regulatory enthusiasm to try and make an example of people early on before the funds dry out. The trick will be not being someone who's caught and being forced to comply. So it's progressing through Parliament, second reading. It'll come into force 6 months after the bill is finally approved. And I think now, and we did a presentation, the same presentation in Queenstown, and speaking to the ASB and BNZ people down there, the banks are now starting to come alive to the fact that this is going to be a requirement. For a lot of them, it's new territory, like bonds as well. Often, I think, quite difficult conversations will need to be had because the people that you deal with at the bank won't necessarily know what the requirements are and what needs to be done from the bank's perspective, but just making sure that the accounting systems and the treatment of the money by the bank meets the requirements of the Act. So there have been a couple of cases as well quite recently. The Hanlon Plumbing and Downey Construction, that was after the Ebert decision, but as an example of the court actually going against the Ebert decision and deciding that the balance of convenience, if you're trying to seek your payment of your retentions of the money being held in a clearly identifiable trust account, meant that the court was comfortable to order that to happen in that case. So the law is heading in the direction of this authority, but that party had to go to court to get the order to force the trust to be created. And McVeigh and Deckmill, that's a more recent case, and that's an example where a liquidator sought a court order to be appointed as receiver of retentions fund. Normally it makes sense for that to happen because somebody's got to do it. And it makes sense for it to be the party that's got access to the company's records. However, in this case, some subcontractors opposed that application because the retention fund had already been treated as a company asset and had been depleted, and the liquidator had a conflict of interest, and that he was being personally rewarded in terms of his fees for essentially not paying out on the retentions that people were owed. So it led to quite a stoush, and the court was satisfied that the retention money was trust money and not part of the general pool of funds in liquidation and can't be dealt with by a liquidator as such, and they did not appoint Mr McVeigh as the receiver of the retention fund. They appointed somebody else. I think the court was deeply unimpressed by the fact that the retention money had already been dipped into to the tune of millions of dollars for no appreciable purpose and for no benefit to any party that was owed a retention. So you can talk about convenience all you like, but if you've acted like that, you can't expect much sympathy from the court. See, it's hard. That demonstrates this is difficult stuff. And this construction, because there's a hard hat, there's a calculator, because we talk about money, and she's just going, oh, what's all this about retentions? It's terrible. So slight difference between receivers and liquidators. I often get people going, oh, well, there's only a receiver appointed, that's good, isn't it? Well, no, it's a bit more complicated than that. Receivers and liquidators have fundamentally different jobs. Receivers are appointed under an instrument for the benefit of somebody who holds a security to secure assets and pay out that security. So they're going in there, appointed by a bank or someone else, to ensure that security is met and that the assets of the company are used to pay that security. They don't replace the directors, they can't continue to run the company, but they can control the company's purse strings. So that's the role of receivers. Often they do continue in trade because that's the only way to keep the money coming in and pay out the security, but not always, and they do have a different job. Liquidators are where typically either a creditor has put a company into liquidation or the directors or shareholders have determined that it's no longer capable of continuing, and the liquidator takes control of the company and the directors have no residual power or anything else. All those things have been argued. Back in the day, I used to try and liquidate a couple of well-known property developers in town, and their lawyers always argued that there was somehow a halo of a residual director's discretion to continue to control operations. There isn't. The directors are replaced by the liquidator. They step in, and often they will determine that the most cost-effective course is to wind things up, but liquidators can continue to complete projects and pay contractors and subcontractors and the like. It depends on where projects are in their life cycle. But I just thought it was worth pointing out those two things have fundamentally different situations. They can exist at the same time. Sometimes they talk to each other, often they don't, but they have different jobs. Liquidators have to act in the interests of all creditors. There'll be priorities given to the people that have priority under statute, like the IRD, and then you've got your PAYE and other things, the secured creditors and unsecured creditors, but they have to act for everyone. The receiver just has to act for their appointing creditor. They can't act in bad faith and they can't sabotage the company, but they're only there after the interests of their appointing party. So if a contractor or subcontractor or supplier is insolvent and there is the appointment of a receiver or liquidator, it will often be an event that triggers the termination of a contract by itself. So have a look at the conditions. Act fast, secure the site. Easy to say, having memories of what happened when Mainsfield tipped over and you get one poor security guard in a high-vis standing there trying to stop 60 angry subbies from getting their tools back. It's a bit of an ask, but you secure the site, identify and discuss any potential deal for any of the assets or other items of value to you. Look at whether the contract's been automatically terminated, and also is direct contracting possible. So before the plumbers come in and rip the stuff out of the walls, or these days probably people start carefully trying to unscrew jibboard, you need to have the discussions to talk about direct contracting to see whether the project can be finished, because always, or pretty much always, there is much more value in a completed project than there is in a hole in the ground. That's the stockpile that those other people were looking for. It's in somebody else's workplace. Where could that be, do you think? Yeah. Well, we like provisioning.
It's our sideline. So I'm going to talk to you now about some of the things and rights that you can have in your contracts and things you can do to try and help in the situation where there is an insolvency in a project. And I think the first thing to say before I go into this is it's important to note that the majority of these rights have to be in the contract from the start. We frequently get asked to help out when things go wrong, and there's some suggestion that we can imply these things into the contract after the fact. You can't. They need to be there from the start so that you can rely on them. Just some early warning signs, you'll all be aware of these, but for projects that might be going into insolvency, staff changes is a good one. So you suddenly see an awful lot of staff changes within a business, or staff reductions, changing staff. Increase in variation claims. Contractors or subbies all of a sudden will put in a flotilla of claims all at once to try and recoup some money from a project. Complaints from other people involved on the project down the supply chain that they're not being paid. That's quite a common one, and we hear that one quite a lot of, I've heard that so-and-so's not been paid for a while, but we've been paid. And principals choosing who they're paying to depending on who they think is more important to keep the job going. And persistent rumours in the market, which is probably the most important one, and the one that you'll hear the most is you'll hear noise that something's happening or someone's struggling. Payment protection provisions in the Construction Contracts Act. So I still see an awful lot of queries around payment and payment claims and payment schedules. So broadly speaking, these provisions were brought in under the Act to try and keep cash flow moving in the industry. It doesn't quite work to do that, but it's a good start. The first thing to note is a payment claim has to be in a certain format as set out in the Act. Just because it's an invoice under a construction contract does not make it a compliant payment claim. And there are certain things that have to be followed, and the courts have been very strict in upholding that the form and the content has to be exact. The most common thing I think it's fair to say we see is there is a advisory note that needs to be attached to the back of a payment claim. It needs to be attached to the back of every single payment claim for a job. The fact it's been sent once doesn't suffice. It has to be on that one. And just a note on that is that that advisory note has changed over the years. So people that are using templates from a number of years ago, your advisory note is probably in the wrong form. It's not changed dramatically. It's a few words here and there. It looks the same, but it is a different form, and if that form's not correct, then it will be invalid. It's also worth just pausing and noting that the Construction Contracts Act covers a very wide range of people involved in a construction project, so pretty much anyone providing a service in relation to a construction project is covered. So consultants, design team, architects, they're all covered by these provisions as well. We would recommend that regardless of whether the contract specifies it should be a payment claim under the CCA, that you do invoice in that manner, because if you don't, you can't rely on the protections under the Act. So if a payment claim is served that complies with the requirements under the Act, then there's a certain period during which that has to be disputed by way of a compliant payment schedule. And again, the Act sets out the requirements for what must be set out in a payment schedule. And recent cases have suggested that the level of detail does not need to be relatively specific in terms of line by line going through the payment claim, and if you're disputing an item, explaining why. There is nothing in the Act that then covers you in the event that something is disputed. If it's disputed, and that can be a lot of the reasons where a lot of problems lie, in that people get a payment claim back and go, but it's not right. That then goes into the dispute resolution procedures under the contract. There isn't then another bite of the cherry. So provided that payment schedule is served within the requisite period, which is either the period in the contract or the default period under the Act, then the principal has to pay the undisputed sum of the schedule. If the schedule isn't served or isn't compliant, then you have to pay the full sum claimed and bring the dispute later. So it's pay now, bring the claim later. And that was the whole point behind it. It was to try and increase cash flow. So the main issues around payment claims and schedules that we see is non-compliance, or they're not served within the requisite time period, and it can differ from contract to contract and job to job. So just because it's a 3910 contract, there might be special conditions that change it, and we frequently see particularly tight timescales for compliance with payment claims and payment schedules, as little as sort of 2 to 5 working days, which can be very tight in terms of actually assessing on site whether a payment claim is due and payable or not. That's what people are going to have to start building out of when we run out of all materials entirely. I have some Lego at home. Bonds and guarantees. So performance bonds are a major form of contract security. Over the last, I'd say, 6 to 9 months, there's more resistance in the market to giving bonds, predominantly because there's so much construction going on in the market, and constructions and subbies see themselves as being in a relatively strong position, so resistant against providing bonds, retentions, anything that is seen to tie up money or security in any kind of way. Principal bonds were already less common than contractor bonds. Bonds can be provided by the banks or insurers. There's two different types of product, and they depend. One requires some kind of securitization normally, and the other is a premium type insurance product. And you get different types of bond, and it's important to check the type of bond that is being provided or asked for. So the most common form of bond is an on-demand bond, which is very simply, you go to the bank or the insurer and say, I am due this payment, and they pay out. They don't check why it's paid out, whether you're right or wrong, they just pay it out. And banks and insurers quite like that model because they don't want to get involved in a dispute, or a challenge that they've paid out incorrectly. Or you have conditional bonds, which will provide, for example, that a bond can only be paid out in the event that PC hasn't occurred, there's been a breach, there's been a payment default. So as I say, the most frequent form of bond used is the on-demand bond. It's therefore important to have in the contract when a bond can be called on or not, which will normally be those type of things. So material breach that hasn't been remedied, PC's not been hit by the required date. If you believe a bond is about to be called upon, so your bond, it's important to act really quickly. You may or may not get wind of it, but if you do, there is a possibility, a slim one, of getting an interim injunction which stops the bond being paid out. It's difficult to get. You have to prove that the calling of the bond is going to cause irreparable harm and that it's being called upon incorrectly. The alternative is the bond has been called upon and it's been called upon incorrectly, then essentially you have a claim to sue for damages, so the cost of what's been taken out of the bond plus damages on top. But it's important to act quickly because you'll have an obligation to the bank, usually, who's provided the bond, to replace the security that's been taken out. Personal Property Security Act, so it's been around for 20 years or so now, getting on, but it's underutilised in the industry and frequently misunderstood. So this is to get around the issue Jonathan was alluding to before of the main zeal stuff on site, people not able to get to it, people taking other people's stuff off site that might look a bit better or a bit nicer and thinking they might quite fancy that. So what it does is if you own something but someone else has possession of it, so the classic example being stuff on site that you've put on site, unless you meet certain requirements under the Act, then you can lose ownership of that property. So it might be your plant and materials on somebody else's site, but if it's on their site, there's a risk that them or somebody else can take possession of it and you lose it. So things it can apply to, as I was saying, pretty much anything on site. So your tools and equipment, materials on site that haven't yet been paid for, temporary plant and site offices. It's a really simple tool to use if you use it right. It's all done online. It's dead cheap and easy to do. It's just a case of having the evidence and following the process behind it. So you need to have a clear record of what you own, which I appreciate can be quite an enormous task on a large job to have lists of all your plant and material on site. But on the other hand, the risk of not doing it is you lose it. So it goes back to the record keeping Jonathan was talking about earlier. A process by which ownership is acknowledged, so that's usually a line in the contract, which just acknowledges that the principal acknowledges that the stuff on site belongs to the contractor until such time as it's paid for or incorporated into the works. And you then register the interest on the register. So you register it against the name of the principal. It's important that it's clearly marked on the register. And effectively, it then works in a priority format. So if you have priority on the register, you take priority over somebody else. So banks have been using this and are really good at using this, and they've used it for years. And other people also use it quite well, but it's just underutilised in the industry, and it's an important tool to have. Step-in rights and direct payments agreements. So again, Jonathan alluded to these earlier, and again, it's something that banks and financiers have been using for years. So this effectively gives principals or head contractors, so somebody higher up in the project chain, the right to step into an agreement in the event that the person beneath them it terminates or they go insolvent. It can be a really good way of keeping projects moving. So for example, if the head contractor goes insolvent, it allows the principal to step in and have direct payment rights to the subbies, keeps them on site, stops them suspending under the Act for non-payment and leaving, taking all their tools. It can be a really useful tool. It needs to be in the contract to start with, otherwise you're down to having a conversation on site when it all goes wrong and trying to work it out. I advise it goes into every contract. I see no reason why not. It only comes into force if it terminates or goes insolvent, so what's the issue? From a subbie's point of view, it means that somebody else is paying you what you should have been being paid anyway, and you get to the end of the project, which you'll have timed and programmed your business for. So I personally see no, as long as they're drafted correctly, see no great downside to them and they're used correctly. Supply chain issues, you're probably all bored of hearing about supply chain issues, but they're here, they're a reality, and they're not going anywhere for quite some time. It's important to have some flexibility, so we're seeing an awful lot of substitution of material clauses, but having the flexibility with the control. It shouldn't just be a right for contractors and subbies to substitute materials with whatever they like because they happen to have some of that lying about and it will do. It shouldn't detract from the quality or the appearance or the functionality of what you intended to be built. But on the other hand, it's important to allow for substitution of materials. You don't want to be waiting a year for one particular type of material when something else could be used. And it can also help with cost fluctuation and increases if something can be got earlier, but there should be an approval right and a process by which it goes through. Advance payments, so they've been around for ages and quite commonly used in the market with your off-site and on-site advance payment agreements that are quite familiar with the NZS contracts. And basically you pay ahead for a material on the basis that you then take ownership of it. It's clearly marked, insured, etc., but title becomes yours. They're very frequent at the moment, and we're even getting projects where clients' principals are procuring materials at the very start of a tender process or way ahead of a tender process just to get guarantee of materials and a price now. Treatment of deposits, so that's becoming more and more common that people want deposits for materials to again secure the supply chain and the price. The difficulty with deposits is they can't be treated in the same way as advance payments. So the benefit of advance payments and the way that mechanism works is that that title passes across to the principal. So you've paid for something, but you own it. With deposits, you'll have only paid a proportion of the price, so they'll still be owned by the supplier. They won't yet have passed through the chain. They won't be owned by the subbie. They won't be owned by the head contractor. So they can't transfer title over to the client or the principal. So they don't fall within an advance payment agreement mechanism. So some clauses we've been working into contracts around those is a right for a subbie or a contractor to request a deposit for material because it's a sensible thing to do. But in the event of termination of the contract, either that deposit is repaid or the supply agreement is assigned across to the contractor or the principal, so that they would have to pay the remainder of the price, but at least they don't lose the deposit. The risk of paying deposits as a principal or a head contractor to your subbies is that you've paid for something you don't get ownership of and never do. Early procurement, so we're seeing more and more different contracting models, so ECI approaches, two-stage contracting, getting people on board really early. Pleasingly, from my point of view, that's bringing in a little bit more collaborative contracting, which is helpful, but just people going to the market earlier and getting contractors involved earlier. And analysis as to what specific materials are cause for concern. So this is around cost fluctuations. So I see a whole range of cost fluctuation provisions and clauses. I was reviewing a contract only yesterday which had what the contractor thought was a cost fluctuation clause in there, but it only related to cost fluctuations that were a direct result of COVID, which I don't think they are in a lot of cases and is very difficult to prove, so I don't think that really gave them any cost fluctuation clause at all. NZS cost fluctuation clauses, as you'll know, are an index-linked based formula that bear no reality to the current world we're in terms of cost fluctuations. But on the other hand, an 100% pass-through on cost fluctuations isn't necessarily fair or reasonable. It's a risk that it's neither party's fault. However, there is an argument that contractors and subbies are slightly better placed to manage it than principals or clients because they should be able to manage their supply chains a bit better. They have that control. There will also be materials they already have or they know they can secure the price of. So it shouldn't necessarily be the case that every single material in a contract should be subject to cost fluctuations. And what I find a sensible approach and encourage parties to do is sit down and genuinely discuss what materials they are concerned about. And you can often get it to a list of 5 or 6 items or areas, and those are the ones that cost fluctuations apply to, and the risk sits with the contractor on the others because they can manage that risk. And then you just have specific ones. There's also clauses out there whereby different parties take different percentages of the risk and that kind of thing, or costs fluctuate, the prices are fixed to a certain date, which is becoming shorter and shorter, and then it will go. I'm seeing some at the moment where tenders are going in where the cost can only be fixed for, it wouldn't even cover the tender process because they can't get it from their suppliers. So it's a real issue, but there are things that, sensible things and conversations that can be had to try and manage it for everybody. And pleased to know, that is the end of the presentation. Just some other things that it's worth bearing in mind and discussing, and Jonathan will chip in on a few of these as well, is in the climate current as it is, it's important to be, as always, and we've spoken about this before, being prompt with notices around things like variations and extensions of time. So the old tradition of keeping everything to the end of the project, it'll all be okay and we'll sort it out at the end, is particularly risky at the moment. So not only do you run the usual risks of being time barred and not being able to claim, but there might not be somebody there to claim from at the end. So being prompt with those notices and getting them in is worthwhile doing. Another bugbear of mine and both myself and Jonathan is if you're entering into subcontracts, which can be quite chunky subcontracts, is making sure you know what you're signing up to, which sounds daft, but the number of subcontract reviews I do, and the first thing I always ask for is a copy of the head contract and get the response of, we don't have it. And you'll see in the subcontract you're obliged to comply with all the provisions of the head contract, which you won't know if you don't have it. There's also clauses out there which, for example, will say you can only claim a variation if you can claim it under the head contract. So you don't know whether you can claim it or not. Extensions of time, likewise. And particularly, we're seeing more use of non-standard New Zealand contracts in the market. So Australian contracts, bespoke contracts. I'm seeing more NEC. I've had a few FIDIC ones over my desk recently, so contracts that aren't the norm for people, and just understanding the provisions in each and every contract so that you don't trip up.
Yeah, there's the non-standard contract issue is a huge problem with the administration. You usually find in the history of the contract it's been recommended by a particular consultant who's no longer with the project. It's like that Simpsons episode where they sell the monorail. They come in, they sell the idea of this, your NZ standard contracts, they're no good, you need this. Look, there are books, they're different colours, it's shiny, and then they leave, they go off into the sunset, and the party administering the contract has no idea what the requirements are. The parties who are performing it assume that they're just able to continue as they would under what they considered normal industry practice. And everyone's very surprised to find that the administration requirements, particularly if there are engineers to the contract involved and other people who then have this huge administrative burden. I mean, NEC is shocking. And the timeframes for notices are really short. And if you don't respond within the specified time, you get nothing. Like it really is like a Wild West shootout scenario, and that's for every variation claim and every extension of time claim. So the sort of traditional approach of we'll deal with variations and EOTs and the wash up at the end doesn't work because the contract expressly excludes you being able to claim anything. And we often see that. The other thing I'd add from it, coming from a disputes perspective, is where you get something's in dispute, you look at the contract and it's not with a legal entity. So the basics, even the very basics, are not right. There'll be a trading name, or there'll be family trust, or something else which is not a legal entity. It's not capable of suing or being sued. There will be notice provisions in the contract which have not been followed. There will be an assumption that terms, your standard terms, which you've paid for, you've got lawyers to draft, or you've at least gone to the trouble of Googling it and spending 5 minutes ripping off somebody else's and changing a few names. You've gone to all that trouble to protect your business with something that you like, that's not in your contract. It's not, you might be sending stuff or invoices saying subject to our terms and conditions. The contract that you signed up to has a schedule in it that says the contractual documents are this, this and something else, and doesn't list your terms. So they're not part of that construction contract. All those things happen. When you're in a dispute, you can't fix that. The only time to set out the framework to protect yourself from a risk perspective, and this comes to making it easy to recover money if things do go wrong, the only time that you can deal with that is when the people are talking to each other, when the relationship is good enough that each one has something which the other wants. You can't fix that when the wheels fall off. You won't be able to find the people that you were speaking to at the beginning anyway, but nobody's going to be wanting to give an inch. So the only time to sort that out and to get into good, healthy processes of record keeping is to make sure that you have contracts which are, even down to when you're getting personal guarantees signed, make sure that all the guarantors actually sign it. Making sure the version of the contract that you've got has all the pages in it. Even little things like that. I've spent many a happy half day in the High Court trying to explain why key pages aren't in contracts, but people assume that they were. And the other thing where it breaks down, particularly if work on site is getting frantic, is the old chestnut of verbal directions, work being carried out, but no instructions in writing. Those kind of things, if they're not dealt with at the time, there's at least a communication back saying you've instructed us to do X, Y, and Z, so we're treating this as a variation. Then you get all the game playing around things not being treated as a variation, requiring people to do it but not paying for them, and that can lead to unnecessary disputes and delays. And the only way to try and mitigate that is when the parties are actually in a better phase of the relationship, assuming it. Everything always goes bad for me, so I always look at the negatives. I deal with ambulances that have fallen off cliffs, and I go through the bits at the bottom to try and make other ambulances. So I always take a very cynical perspective of these things, but the only time in the relationship where you can sort all that out is at the beginning, and that's the only time you'll be able to, for example, get the head contract. And there are people who play games with that, and they say, well, you can look at it, but you can't take a copy, or you can only look at 3 of the 279 pages because the rest of it's commercial and confidential. Well, it might be, but I'm also subject to it, so I'm part of that confidence. There's no reason why, if you have a subcontract that's subject to a head contract, usually with indemnities and back-to-back obligations around liquidated damages and horrendous things in it, you must be able to see the head contract. You must be able to assess risk. But there are some pretty unhealthy practices in that space, especially when the principals are based overseas. They have a, you can't see kind of approach, which isn't helpful. But there's a lot of practical stuff that can be done, record keeping stuff, even really mundane things around engagement processes, making sure that your tag lists are there. And also, unfortunately, there's no substitute for actually reading the thing. It's horrible, but read the contract and the 150 pages of special conditions that other large North Island-based law firms seem to insist on stuffing into construction contracts. And you'll find people do try and put in design fish hooks into the specification, that kind of thing. And the only way to avoid contracting for something that you're not prepared to provide is to read it and then identify those issues. And there is no substitute, because otherwise if you sign something it's inside the document, it's very hard to argue, well, I might have agreed to that, but I didn't agree to it. I didn't accept it as part of my business risk. As I accept that it's recorded there, but I assumed that it wouldn't be. It's not a very good argument to run.
Yeah, the other key thing with tags and bits from a tender response is to make sure they're in the contract. So they've been incorporated in that list of documents at the front, but they're in the right place. So quite frequently I see tags at the bottom, which means they're overridden by everything else above it. So you may think you've got the benefit of a tag, but actually it's been overridden by the general conditions or special conditions, or something hidden in a specification is normally quite a good one. So it doesn't apply. So you'll have carved out, I'm not covering this risk, or I'm not covering that type of material, and actually it's in the spec and you're bound by it. That can be another frequent one, is to shove things down the bottom. The best thing to do is to put the tags in the special conditions, so then they sit at the very top and they're incorporated in and everyone understands and knows what they're signing. So Does anybody have any questions?
One
Sure.
question. With regards to the bank trust for retentions, will there be any requirement on the bank to have a correlation between what's in the trust account and maybe what the company's annual turnover is? Will there be any requirement for them to see there's sufficient funds in that account?
The bank's job in administering a trust account under the Act is just purely to maintain it. They don't have any oversight over the trust account versus the running capital of the company. But the importance of the Act saying to notify the bank is so that the bank knows, and this is why it's frustrating and somewhat confusing for banks when companies go into liquidation. The bank knows that it can't touch the money that's in the trust account because it's not an asset of their client. So that money actually, the beneficial ownership of the money in the retention account is someone else. It's a party B somewhere. They can't administer that account. They can't provide, other than providing it to the receiver or the liquidator, they can't provide information about that account to anyone else. But they can't claim it or use it to pay off what the customer might owe them as a result of their default if they're not running sufficient capital. The bank might have other mechanisms if they have concerns about the operation of a company. They might have other mechanisms in their contractual relationship to step in and talk to them about if they're concerned that the company's going to tip over. But I think it remains to be seen, because we're going to be seeing the creation of a lot more of these retentions trust accounts, how the banks will deal with them from their risk perspective as well, because it's money that's sitting there that they can't touch. And they have the burden of it's a relatively small burden in the greater scheme of things, but they have the burden of maintaining the trust account and ensuring that they only respond to the proper instructions about where the money's to be paid out to. So that under the new regime, it'll be receivers and liquidators properly appointed. As things are now, you would need a court order. So it sits there, and you'd need directions from the court to enable the liquidator or a receiver to direct those funds to be paid out. But what they'd also have to be alive to, I don't know what they could do to stop it, is if you have a fraud type situation where a company's tipping over and a director takes all of the money, they'll be in breach, but usually that'll be the last thing that is on their mind. People emptying out the retentions trust account for personal gain. So a director clearing it out because they're going to take off because their company's tipping over. They might have processes in place to be alert to that type of transaction, like with a credit card transaction that's unusual. You wouldn't expect to see a retention account completely emptied in one transaction. So I don't know, but I'd be interested in having these discussions with banks as to whether they have something to stop that from happening. It's relatively rare because the collapses are usually so profound, and it's not. But with some of the smaller businesses I've seen that has happened. But with the larger ones, the systems are in place, and the collapse is usually so sudden that there isn't even the opportunity to do that before things are shut down.
From a solvency perspective, if you look at the example of retentions at their trust funds, you'll find that a lot of construction companies will be right on the edge, if not insolvent, when you take into consideration retention liability if you're a main contractor.
Yep.
And if you can't take your retentions owed by your principal as an asset until the question is, at what point in time does that become an asset from a solvency perspective? Because it's due.
It's due, but it's conditional. So
yeah.
It's not a liquidated sum that's due and owing. It is a sum that's been set aside. You're a beneficial owner of it, but your entitlement to it only gets triggered by the relevant part of that contract being performed. So, and if there is default or there's defective works or something else that enables retentions to legitimately be held back, either in whole or in part, you don't get all of it anyway. So, to answer your question in terms of when you're entitled to treat it as an asset, it's when the relevant contract says you can. So when it's being performed, up until then, you have a beneficial ownership in it, but not the legal control of that, which is why you can't. It's tempting to think of it as, I have those coming to me, so they should be seen as an asset, but really they're not until the contractual conditions are met. It's a bit like, having money coming to you in a will, but it's only going to get triggered by when you're 21, that style of thing. But in a contract form, there are other models of administering retentions in other jurisdictions where, for example, all of the retentions, and there's a minimum threshold, but all the retentions are aggregated into one bank account and administered usually by the engineer to the contract. And that is on a project by project job. So rather than an individual contractor holding it over multiple contracts, it's actually the retentions are dealt with in a job specific trust account that's set up with complex reporting mechanisms for that. And that seems to work quite well, but that's not the process that we've adopted. And I think one of the criticisms is we have no minimum threshold. And to sort of relay back to your point about a lot of construction companies having problems with liquidity and retentions basically being a burden on top of that, is that it takes a lot of money out of the construction sector. So it's just sitting there off to one side. And we know that when PwC did their assessment at the beginning of the Construction Contracts Act when it was first being drafted in 2002, and they pointed all this out, that because of the way in which we've approached retentions, it's like a layer cake with everybody holding money back in every stage that's not able to be used. It took billions of dollars out of the construction funding pool for New Zealand nationally, and that was sort of met with shock and denial by the people drafting the Act, and they forged on regardless. But it is what it is. We can't pretend it's something different. But I think it's fair to say that wasn't fully appreciated. So they were looking at it from the point of view of the legitimate concerns of people not getting paid retentions because the money's not being withheld, and some pretty rough practice around that. But there is also the problem in obliging money to be held at all levels that you can't touch, that it does make looking at the solvency of your company, if you're a director and times are tough, it does make that quite a complicated exercise, because essentially the retention money is off to one side. You've got your burden that you're holding against somebody else. Somebody else might be holding something for your benefit, but it's only triggered by specific events. So it's tough. And having good conversations with the banks and also keeping alive to cash flow is probably the only real solution. And the Mainzeal case has shown that people can look to directors in the event that there has been trading while insolvent on a if there's enough reward to go after directors, there is the ability to do that. Having said that, we're now coming up to the 10th year anniversary of the parties owed money, the creditors owed money by Mainzeal following its liquidation, and they haven't received a bean. So I don't want to overstate the risk, because even with litigation funders, you're not going to get a quick result. In fact, it's the 10th or 11th. Yeah, it's coming up to the 10th anniversary of the funds being owed. So it's not a quick process, and hasn't finished yet. It's gone to the Supreme Court, and at the very best will be referred back to the High Court to talk about numbers again.
I think one of the things, just to add on retentions, that we're starting to see more of, again, it's partly to address that kind of solvency and when it becomes yours type point, is a move away from the traditional release model of it being 50-60% on PC and then the remainder at the end of the defects period, to a graduated release during the life of a contract, taking the approach that the risk declines as more and more gets built and done. So you'll see earlier releases to try and get through some of this cash flow and solvency type issue of being able to show when it is yours by getting it released earlier. So that's becoming more common, particularly on long, complicated projects.
That is a very good point. That is a real problem. People can, if they don't pay attention, they can sign up to a situation where, even though their part of a project is long finished, that their final retentions are not released until the completion of other works which are nothing to do with anything that they've been doing, but unfortunately that's what they've agreed to, so they can a really long tail on the release of their retentions, and that's you can get into that just by signing a piece of paper that has that as your retentions release requirement, and it's not fair, but again it's very difficult to argue against that once you've signed up to the piece of paper saying that you agreed to it.
Yeah, and not realising that, so the retentions you've taken from your subbies or suppliers are released much earlier, so they're released when they finish their works, but you don't get released
so
until
you've
the
paid
top
up,
of the
you
project.
haven't received your payment for the same job, so that's quite tough.
And as a subby to a main contract, you don't necessarily have that negotiability
No.
with the main contract.
No.
That's the issue.
No, but I mean, I see that an awful lot in subcontracts where their retention is held until final completion, and final completion is defined as final completion of the whole project, and they might have finished years ago and have long gone, but they've assumed or read it as being completion of their works and think, right, okay, that's fine, we can live with it for 6 months from our works, but actually it's a date that you've got no control of, that, and we all know how long beyond dates projects can go, and you've not planned in your business for it to be held for 3 years, you've planned for it to be held for 6 months.
So if we're requesting information from let's say on a subcontract, requesting from a main contractor about retentions, what sort of reporting would you expect to be receiving?
Under the Act as it is, so before the obligation comes in for them to give it to you anyway, they have to, if you ask them, they have to give you suitable financial information to support the retentions that they're holding. What that is isn't defined, but you would expect to see something. I would push for something a bit more specific rather than just a letter saying suitable retentions are being held, because that doesn't answer the question. And what you want to know is that it is being held on trust, and also that there is a specific account or something holding some money which is suitable to meet it. The problem we've got at the moment is that the Act doesn't actually still technically allows you to commingle and doesn't require you to have a separate trust account. So there are cases that have said, yeah, you should really have a separate trust account, but the Act, until this amendment comes through, is still pretty fast and loose and doesn't require you to do that. But I think the fact of asking for the information at least forces whoever's holding the retentions to turn their minds to that, and hopefully to provide enough information. And you can keep asking. This is the thing that people suggested to me was too awkward to do, but frankly, if you can't be bothered asking, you've got to take the risk of a nasty surprise. And you know, it's not vulgar to talk about money. It's one of the aspects of the industry. They should be giving you financial information, not all of their accounts. And you get people going, oh, I'm going to tell you everything. Well, you don't have to, and that's not what the Act says, and it's not what the court says. But you have to give me enough comfort that there is that sum of money in there. One of the problems that we'll have, even if people are saying, oh, I've got 20 grand in this account to cover retentions, is that you don't know whose money that is. Like, it covers my retentions. You've got 20 jobs on the go. So does it cover everybody's? Is that 20 grand to cover the $240,000 that you should be holding? Who gets that suitcase first in the event of things tipping over? But asking is the best you can do. There's no enforcement provision in the Act as it sits. People are saying, oh, you'd be in breach of your duties as a director and you'd have to trot off and blah, blah, blah. Yeah, good luck with that, going off and getting declaratory judgments under the Companies Act or arguing a breach of the Trusts Act 1956. You'd be in court. You'd probably get a judgment of 2035. So the mechanisms for enforcement are not there. But nagging, I'm a big fan of nagging. Nagging is actually, in a polite, informed business way, is actually probably the best tool.
But there's nothing to stop you contractualising it, and that's in anticipation of the Act coming in, and because of some of the issues coming out of things like Mainzeal. That's becoming more and more common, partly as a negotiation tactic, which is if you're going to ask for a retention, then I'm going to make your life as difficult as possible to hold it, which is a good tactic. but also in terms of saying, right, okay, I'll give you a retention, but it's got to be held in a separate account. It's got to be in a named account.
Yeah.
It's got to say it's on trust. You've got to provide me with X, Y, and Z pieces of paper, and you've got to keep providing that to me every time I ask for it in the same way that you have clauses saying you've got to prove insurance is in place and show me it's in place all the way through the contract. So seeing more and more clauses like that come in, which I imagine as the bill gets passed and it becomes enacted, there'll become more and more common special conditions. I can see that coming, where in fact there might be although it's not in the Act, the way the contracts are being negotiated and set up will de facto mean that there are separate accounts held for different retentions because contractors and subbies are going to demand it as part of their negotiations.
And then people just have to use those tools. If they put them in contracts, they need to use them. Because we're still seeing a lot of stuff like extension of time provisions and that kind of thing. Those mechanisms in contracts are just not being used until the wash up, the last payment. And then people start saying, oh, we had that bad weather back in June 2014, so you've got to take that into account and all that kind of stuff. Because the mechanisms in the contract aren't being used. So if they're in the contract, you then got to use them. And once that happens and everybody gets more comfortable with it, then I think it will become easier. People then there will probably be a pressure to find another product in the marketplace or other ways of pricing risk or using bonds so that people don't have to go through the faff of holding retentions if that's too much of an administrative burden or if they're getting pushback from banks about having separate trust accounts with balances that fluctuate that they've got no control over.
So are you suggesting that you think that time would be a better solution than retentions?
There will probably be, there's appetite to have something in the market with a financial instrument that qualifies under the Act that will be in substitution for the retentions regime. The bond in lieu of retentions that's in all of the NZS standard form contracts is actually different to this too. And it's also not a very attractive product. I've never seen anyone being able to get one because essentially a third party takes over all of the risk, and usually with inadequate security. Because if it gets triggered, if the real risk gets triggered when your client is insolvent, then unless you've got pretty impressive security, you're just taking on the risk of paying for somebody else's default with no vision over how they've been running their business. So I've never seen those clauses actually used.
No, I think there was an assumption / hope when they were talking about this and bringing it in that there would be an insurance type product out there that would cover the risk, which there is in some other jurisdictions. The problem is there isn't really one over here. I know there's some insurers talking about it, but at a time when insurance generally is retreating from the market and retreating from risk, particularly around construction, I can't see anyone jumping to provide it anytime soon.
Yeah.
Or the ones that will be providing it only to the sort of cream of the crop of contractors who don't have the risk anyway.
Yeah, they'll be offering a product to people that don't need it. And then they'll take on more risk and it'll hopefully expand a bit.
But I think the point that Jonathan and Mark, you're making before about this whole process and system is it's good. What it's trying to do on the one hand is admirable and good. It's going to cause a huge amount of money being tied up. It's that pressure will get round and there will need to be some solution to it, and they rely on this financial instrument, but they're going to need to come up with something, or someone is, because it's going to cause a huge issue to have it all tied up.
I can see that if there is more recognition, and there are surveys done of how these things work in the marketplace, and it depends on the survey responses, but they do get fed back to MB, and they do. I mean, this new draft is actually quite quick in terms of responsiveness to an adverse court case. They've actually got onto it quite quickly. So they are paying some attention, and I can see that we might have regulations which, for example, have a minimum threshold for the obligation to keep retentions. If the administrative burden and the taking of money out of circulation for small businesses becomes a particular problem, then I can see that coming in. But we need regulations as well, because there's lots of other things like stipulating penalty interest rates and all that kind of stuff, which isn't in the Act. And at the moment, unless you have it in your contract, and nobody does, I haven't seen anybody do it, or maybe a handful of people do it, unless you provide for it in your contract, there isn't one. So by that I mean a default. an interest rate for failure to pay retentions as they're required under the contract. And the other thing that you'll possibly then get is people will have to shake out how they're dealing with retentions as well, whether they raise, and Julia used the word spurious before, whether there are rearguard actions fought over retentions release as a matter of course, not because they're actually valid under the contract. Those fights exist at the moment, but it might get worse if there's pressure on, if people haven't been complying and they don't want to be exposed, there might be a bit of pressure there.
And I think there's some logic behind the thought that actually by having a more admin heavy retentions regime being brought in, that it will in practice bring some kind of threshold to the level of projects that retentions are being requested on, because for those small projects it's going to be more hassle than it's worth to hold it and manage it and deal with all the hassle coming out of it and there are other ways of making sure you get built what you want built on time and within budget than necessarily retention. So that there might be sort of market forces that might make them being less common, particularly on those smaller projects. Any further questions?
Right.
No? Well, thank you very much.
Thank you very much.
You've all know us or have our details, so any questions that you've got afterwards, then please feel free to send them through.